I'm not a licensed tax advisor, but I know how to explain things in layman's terms. That's the best way to understand something if you talk within the experience level of a typical mom and pop. So the next category is if you make more than 150 grand. Okay, fine, that's great. Make a lot of money. If you make more than $150,000 adjusted gross income with all the depreciation, everything else, you can deduct all your debt service against your rental income, which is good. If you make more than 150K, it could only max out your passive losses against your passive income. So there's a lot of limitations, especially when you're not a real estate professional.
Yes.
But don't worry, because if you buy more rental property, I discussed the fourplex. If you buy more properties and you get high income cash flow that you get, the suspended passive losses, if you make more than 150K, the suspended accumulation passive losses can further reduce your rental income, your cash flow from your additional cash flow property you are buying.
Oh, okay.
So
Wow.
this is a very important topic. So we talk about one property, you're getting $10,000 positive cash flow, right? After all the deduction. If you
Right.
buy more property, if you have the capital, that is, not everybody have money,
Right.
but a lot of
Right.
people still do. They have capital for the down payment to buy
Sure.
second, third, and fourth rental properties. What if you buy several more rental properties and get $5,000 to $10,000 positive net positive annual cash flow? The net positive
There you
annual
go.
is subject to taxation, but if you make more than 150K, any suspended passive losses will be suspended to future years to offset against future passive income. That is the future benefit for people
Right.
with high income.
There you go.
Even if you're not a real estate professional tax rep status. Okay? So
That's good. That's really good.
on your rental income schedule, look, okay, you can, if you buy 3 or 4 or 5 rentals in the next couple of years, cash flow rentals, there's an important distinction, okay? Right market and this and that, but, although we have those kind of products, so you document your, you file your tax return, right? Property A, property B, property C, then property D, then you have positive cash flow. All the suspended passive losses can be carried over to reduce your cash flow, your rental income from your other income property, where you can pay less taxes. Even again, I have to repeat this. Is this the third or fourth time? Let me repeat this. From time to time over the years, my high income investors, they come to me, they say, "See, Wayne, I'm not a real estate professional tax status right now. Maybe in the future I will be. I do not make less than 100 grand, whereby you can deduct up to $25,000 passive losses, just that easy. But if I make more than 150K, I get no depreciation. But you are getting tax benefit. Like I alluded to, let me be very clear. Sometimes people need to listen multiple times before something click in their brain.
Sure. Absolutely.
You make 150K or 200K, $300,000. You are not a real estate professional tax status. We cannot offset your passive losses against active income, against your WC income.
Right.
When you buy second, third, or fourth income property, you're going to pay taxes on it. You could have high cash flow, even with the deductions, even with the debt service deduction we talked about.
Right.
Even without the depreciation limitation you have because you're a high income earner, but the suspended passive losses with the cost segregation or no cost segregation into the future years, those chunk of passive losses you can carry to subsequent years can offset against the net cash flow from your other property. So your other property can benefit from this chunk of suspended future passive losses. At the end of the day, you're still paying less taxes because your rental income are further reduced by those passive loss carrying forward previous years. And then you get the expense write-off on your mortgages, tax, insurance, property management, vacancies, and travel expenses on top of the suspended losses to reduce the cash flow income that you receive from your other income properties.
Wow. That's a win.
Julie, you get what I'm saying?
It's a lot to take in, but I got the foundation. It's like dealing with those passive losses, carrying those forward. And it almost sounds like the more properties you have, the more you're going to benefit from that strategy.
Exactly. You got it, Julie.